Silver isn't just rising, it's going missing in real time, and the people who normally make a tight two-way market are quietly stepping back as if the floor under available supply just turned to glass. The headline crowd is staring at the spot print and arguing about whether $90-something is too high, while the real signal is flashing somewhere else entirely. In the friction, in the spread, in the delays, and in the way dealers are suddenly talking like they're managing a shortage, not a rally. And if you stick with me to the end, I'll give you the cleanest way to track whether this is heat or true scarcity, plus the two price zones that matter most over the next week or two. Because if one level breaks, the math changes, and the next move won't feel gradual. Right now, the price action is doing something that markets only do when liquidity is thinning. It's just not trending, it's lunging. We've had prints above the low 90s, a reported tag above the low to mid 90s on spot at one point, and on some screens and contracts, even a break above 100 that suddenly forced everyone to say the quiet part out loud. This is no longer a normal silver market. That's not a victory lap, that's a warning label. Because when a market moves fast enough, the question stops being what are S it worth, and it becomes can you even get it, and at what spread and on what timeline. And that's where the real pressure starts. Let's define what people mean when they say silver is turning illiquid at dealers, because that phrase gets tossed around like a meme, and it's actually very specific. Illiquidity at the dealer level doesn't mean the metal is scarce on earth. It means the pipes that turn wholesale metal into retail product are choking at the exact moment demand is surging and hedges are getting expensive. It means spreads widen. It means buybacks get capped or repriced with more padding. It means you stop seeing clean, tight quotes, and you start seeing call for pricing energy. It means in stock becomes a soft promise, not a hard reality. It means shipping windows stretch, and the moment you hesitate, the lot is gone. And the next detail is what flips the whole setup. Those dealer symptoms often show up before the spot chart looks dramatic, because the dealer is living in replacement cost, not last trade. Here's the trap most people fall into. They hear inventory, and they imagine one big, honest pile like a pantry shelf. But metal's inventory is not one pile. It's categories, it's ownership, it's location, it's deliverability. It's whether it can actually move when someone demands it right now. And that ends the hidden detail I want you to carry for the rest of this video. The inventory that gets reported can look fine, while the inventory that matters, the deliverable. Immediately available supply that actually clears promises can be tight enough to make the whole system twitchy. That's not conspiracy, that's structure. If you understand that structure, you stop getting hypnotized by the calm moments on the price tape, because you realize calm tape can sit on top of a stressed physical chain like a thin sheet of ice. So let's talk about the physical chain the retail world depends on, because this is where premiums are born. A retail dealer isn't a miner. They're not a refinery. They're not a mint. They're a distributor with a storefront and a risk book. When you buy a coin or a bar, you're buying a finished product that has to travel through multiple bottlenecks, sourcing raw metal or wholesale bars, refining or fabricating, minting, packaging, shipping, insuring, hedging. Each of those steps has lead times. Each of those steps has capacity limits, and each of those steps gets uglier when volatility spikes, because the cost to hedge explodes, and the risk of being wrong about replacement cost becomes a business-ending problem. That's why premiums don't behave like a polite percentage add-on. Premiums behave like an alarm system, and that's not the part that matters. The part that matters is what premiums force participants to do. When premiums widen and product availability goes choppy, the dealer is signaling something simple. I can confidently replace what I am selling you at the old assumptions. So what do? They raise the premium to protect against replacement cost risk. They reduce the size they're willing to sell at any given moment. They lengthen delivery windows so they can manage sourcing. And they often get more conservative on buybacks because they don't want to be the only bid in a market that's whipping. That behavior is rational risk management, and it asks exactly why the physical market can feel illiquid, even if spot is printing smoothly. Because spot can trade on paper liquidity, while physical has to settle on metal, trucks, insurance, and time. And if that gap widens, the whole market starts telling on itself. Now layer in the institutional side, because this is where the scale shows up. Silver isn't just a retail toy. There are giant pools of metal held in trust structures and vaulted products that can warehouse hundreds of millions of ounces. And that matters, because once metal is sitting inside a large trust vehicle, it's not automatically the same thing as dealer-ready product. It can be allocated, it can be vaulted, it can be structured in ways that directly flow back into the retail pipeline on demand. That doesn't mean it's fake, it means it's spoken for. And the moment investor demand turns that kind of vehicle into a vacuum cleaner, the available float the rest of the market relies on can feel tighter than the headline total ounces in existence would suggest. But the next detail is what flips the whole setup. This isn't just about how much exists. It's about how much is willing to move at the margin. That's why the futures market matters in a way most people never learn until it's too late. Futures are not just a casino. They're a mechanism for price discovery and for transferring risk. But in metals, they also create a bridge between paper claims and physical delivery. And inside that system, inventory is again split into categories that sound boring until they aren't. There's metal that meets the exchange's standards and sits in approved warehouses. And then there's metal that is actually registered, warranted, and available to be delivered against contracts. That difference matters, because eligible metal is not the same thing as deliverable metal. Eligible means it could be delivered if the owner chooses to register it. Registered means it's already in the deliverable bucket. That sounds like accounting. It's not. It's optionality. And when optionality gets expensive, owners stop volunteering their metal for other people's deadlines. Here is the key mechanism. A market can show a large total inventory number while the registered deliverable portion is comparatively small. And when delivery demand rises, whether from hedgers' funds or entities that want to stand for metal, pressure concentrates on the smallest, most immediately accessible pool. That's where you get stress. That's where you get sharp moves. That's where you get people suddenly caring about warehouse reports they ignored for years. And that's where the real pressure starts, because once deliverable supply becomes the conversation, the narrative shifts from silver is expensive to silver is hard to source quickly. Those are different worlds. Now listen carefully, because this next part is the kind of thing mainstream commentary routinely misses. The curve, futures prices across different months, often tells the truth before the headline does. In a normal commodity market with adequate supply and functioning carry, longer-dated contracts trade at a small premium to the near month. That premium reflects storage, insurance, and financing. It's the cost of time. When that structure flips, when the front month becomes unusually expensive relative to later months, that is the market putting a price on urgency. It's saying, metal now is worth more than metal later. And when you see that kind of front-end tightness, it doesn't just affect traders, it affects the entire ecosystem, because it changes the incentives to hold inventory, to roll positions, to lend metal, to finance metal. But that's not the part that matters. The part that matters is what it forces participants to do. If the front month is bid and the back month isn't keeping up, rolling a position can become costly. Carry trades get pinched. People who rely on smooth rolls suddenly feel friction. And friction is how you get price moves that look irrational on a daily chart but make perfect sense inside the plumbing. Because if it's more valuable to have silver now, then anyone who is short now and long later has a problem. They either pay up to find the metal or they pay up to close the risk. Either way, someone is forced to transact in a hurry. And forced transacting is the fuel of explosive markets. Now let's bring it back to dealers, because this is where the audience actually feels it. The retail symptoms are the street-level lie detector test. When you start seeing out of stocks across common products, when delivery times stretch, when certain bar sizes disappear first, when buyback quotes get more cautious, when we can't guarantee ship date becomes normal, those are not academic signals. They're real-world signs that the pipeline is strained, and the strain is often self-reinforcing. Because the moment customers sense strain, they accelerate purchases to get ahead of it. That accelerates depletion. Depletion accelerates premiums. Premiums accelerate urgency. And urgency accelerates depletion again. That loop is reflexive. And if you've ever watched a liquidity crunch in any market, stocks, credit, crypto, you already know how this movie goes. It starts with everything's fine, and then suddenly there's no depth, only air pockets. So what's driving this mechanically? It's not one thing, it's a stack. And if you want to stay rational in a market like this, you have to stack proof points instead of marrying one narrative. Here are the layers to keep in your head at the same time. 1, price momentum and volatility. 2, physical availability symptoms and premiums. 3, the deliverable versus non-deliverable inventory distinction in the futures ecosystem. 4, the curve signal, whether the front end is screaming for metal. 5, institutional flows, big pools of capital that can absorb enormous quantities without caring about retail convenience. 6, macro regime drivers, rates, currency stress, inflation psychology, geopolitical uncertainty that push people toward hard assets. And 7, positioning mechanics, especially options and margin, that can turn a steady move into a vertical one. And the next detail is what flips the whole setup. When multiple engines fire at once, the move stops behaving like a normal bull market and starts behaving like a liquidity event. Let's address the skepticism head on. Isn't this just retail hype? That's the easy dismissal because it makes people feel superior, but it doesn't match the full picture when you look at how silver actually trades. Silver is both an industrial metal and a monetary metal. That dual identity matters. It means you can get demand from investors and demand from industry at the same time. It means you can get a hedge bid and a procurement bid simultaneously. And it means supply doesn't to instantly respond because mining lead times are slow and much of silver production is a byproduct of other mining. So you can just flip a switch and flood the market with new ounces because a chart got exciting. Supply is sticky, demand can be sudden. That asymmetry is why silver is notorious for violent moves. And that's not the part that matters. The part that matters is why now is so combustible. This week, right now, the calendar is quietly acting like a catalyst. Not because calendars are magical, but because they create forced behavior. Month-end and turn-of-month periods change how funds rebalance, how risk managers clamp down, how margin gets recalculated, and how liquidity providers behave. Delivery windows and notice periods matter. Options, cycles matter. And weekends matter more than people admit, because weekend gaps and thin liquidity can do real damage to anyone who is short volatility or short metal. When you're in a market that's already jumping, you don't need a new headline to create a spike. You need a thin moment, an air pocket, where the next buyer has to pay through empty space. That's where the real pressure starts. Now I want to explain one mechanism clearly, because it nets the difference between this is a rally and this is a reflexive squeeze. Options and gamma. You don't need to be an options nerd to understand the basic idea. When a lot of call options exist at certain strike prices, round numbers, popular levels, someone is on the other side of those calls. Often that's a dealer or a market maker. If price rises toward those strikes, the seller of calls can become increasingly exposed. To stay hedged, they may have to buy the underlying exposure as price rises. That hedging demand is not emotional. It's mechanical. It's math. And if you reach a zone where a lot of calls flip from unlikely to padak in the money, hedging can accelerate right when liquidity is thinning. That's how you get moves that feel like the market is sprinting away from you. Because in a gamma-heavy environment, rising price can create more buying, which pushes price higher, which creates more buying. It's a feedback loop. And the next detail is what flips the whole setup. The same mechanism that accelerates the upside can also snap violently on the downside when the move exhausts. So when people ask, why are dealers illiquid? Part of the answer is because volatility isn't free. In a calm market, a dealer can hedge inventory risk cheaply and confidently. In a wild market, hedges are expensive, liquidity is patchy, and the chance of getting caught short product or short protection goes up. So they widen spreads and slow down. That behavior isn't manipulation, it's survival. Meanwhile, in the paper market, positioning can create sudden surges that smash into the physical pipeline like a wave hitting a narrow harbor. That's when you see premiums detach from spot, and people who only watch the spot chart start arguing with people who are actually trying to buy metal. Both are seeing real signals. They're just watching different layers of the stack. Let's make this concrete with the simplest paper versus physical translation that stays finance credible. Spot and futures prices can trade on liquidity and leverage. Physical products trade on metal, fabrication, capacity, and delivery timing. When demand spikes, futures can move instantly because you can buy a contract in milliseconds. Physical cannot scale instantly because you can T-mint 1 million ounces overnight and ship it tomorrow with zero cost. So the physical layer expresses stress through premiums, delays, and availability. The paper layer expresses stress through volatility, spreads, and curve shape. When both layers are stressed at the same time, that's when the market starts to feel illiquid in the places regular people touch. And that's not the part that matters. The part that matters is what happens next, because markets like this rarely drift sideways politely. They either cool off with a structured retest, or they continue into a squeeze that makes everyone feel late. Here's your near-term roadmap, and I'm going to keep it practical. Over the next week or two, there are basically 2 scenarios you should respect, because respecting scenarios is how you avoid getting emotionally hijacked by volatility. Scenario 1 is the controlled pullback and retest. In that world, price backs off from the hottest zone. Think around the psychological century mark and the low to mid-90s area, and it retests the support shelf. Premiums may stay elevated, but they stop expanding. Delivery times stabilize a little. The curve relaxes. The market breathes. That kind of retest is healthy in a structural bull move. It shakes out weak hands without breaking the thesis. And here's the micro cliffhanger. If that retest holds, it often sets up the next leg because it resets positioning without fixing the underlying tightness. Scenario 2 is the continuation squeeze. In that world, price doesn't give you the clean dip you're waiting for. It grinds higher than gaps. It tags above prior highs and triggers mechanical buying, options hedging, short covering, momentum systems that are forced to chase. Dealers get even more cautious because replacement cost risk becomes a nightmare. Premiums can widen further, not because the world ran out of silver, but because the marginal unit is suddenly expensive to source and finance. And in that scenario, you have to respect gap risk. Overnight moves that skip levels, that's where people get hurt emotionally, because the market feels unfair. But the market isn't unfair, it's indifferent. And the next detail is what flips the whole setup. A squeeze can be correct about structure and still punish you if your timing and sizing are wrong. So what levels matter? I'm not going to pretend there's one magical number, but there are zones where behavior changes because humans and algorithms both anchor to them. One is the $100 area because it say psychological magnet and a strike cluster zone in many markets. Above that, the conversation shifts from is this real to how far can it go before it breaks something. Below that, the low to mid 90s area matters because it's ES where recent price discovery has been active, where buyers have shown up and where a break can trigger de-risking. Then you have the high 80s to around 90 zone as a sanity check shelf. If price loses that area and stays there, it suggests either the squeeze fuel is fading or the market is finding a less panicked equilibrium. And the next detail is what flips the whole setup. Don't treat these as prophecy, treat them as behavior checkpoints. Your job is to watch what the market does at those zones, not to worship the zones themselves. Now let's talk invalidation, because this is where trust is earned. If the thesis is physical stress is real and tightening is expressing through premiums and structure, what would weaken it? First, sustained premium compression while spot stays elevated or rises. That would suggest supply is catching up or demand urgency is cooling. Second, a clear relaxation in the front-end curve. If near-term tightness fades and the market returns to a normal carry structure, that's a sign the need-it-now bid is easing. Third, a meaningful rise in deliverable availability in the places that matter for immediate settlement, not just a rise in broad inventory headlines. Fourth, visible easing in dealer availability, products back in stock widely, shipping windows normalizing, spreads tightening. And fifth, institutional flow reversal. If large pools that have been absorbing exposure suddenly start bleeding consistently, that changes the marginal buyer. None of these has to happen overnight. But if several start stacking at once, the probability shifts. Because if this one level breaks, the math changes. Now I'm going to give you the viewer psychology shield, because this is the part almost nobody teaches. And it's the part that saves you money even when you're right. Markets like this will try to emotionally manipulate you using speed. They'll spike up and make you feel stupid for not buying. Then they'll slam down and make you feel stupid for buying. That's not personal. That's how liquidity hunts work. Volatility is a weapon against weak process. The antidote is to separate trend signal from noise. Trend signal is the structural stuff. Persistent premium stress, persistent front-end tightness, persistent demand pull, persistent inability of supply to respond quickly. Noise is the intraday whip, the headline candle, the random flush on a thin book. If you can't tell the difference, you end up reacting to noise as if it's signal. That's how people get chopped to death. So here's the practical framework. Decide your time horizon before the market decides it for you. If your horizon is weeks to months, you cannot let a 3% intraday candle dictate your identity. If your horizon is days, you have to respect that you're trading volatility, not the story. Next, size like you're wrong. Because even if you're right, price can whip around violently. The market can be structurally tight and still dump hard to clear leverage. That dump doesn't disprove the structure. It clears the board. And if you're overexposed, you become forced selling, which means you become the fuel for someone else's entry. Don't donate liquidity. And that's where the real pressure starts. Now let's zoom out one click and connect the macro layer, because silver doesn't move in a vacuum. When rates are expected to fall, or when the dollar is perceived as weakening, hard assets tend to catch a bid. When inflation psychology is high, people look for stores of value that feel tangible. And when geopolitics are noisy and trust in institutions phrase, metal narratives get louder. Add in the industrial angle, solar, electronics, electrification, and you have a demand base that is not purely emotional. But I want to be careful here. Industrial demand is real, but the timing of price spikes often has more to do with investment flows and positioning than a sudden overnight surge in factory orders. The industrial base is the floor, the investment wave is the accelerator, and the next detail is what flips the whole setup. When investment acceleration hits a supply chain with limited short-term elasticity, you get the kind of dealer illiquidity people are describing right now. Let's also address the paper suppression language you'll hear, because I know your audience includes skeptics of institutions, and they're not wrong to question incentives. The finance credible way to frame this is incentives and risk management, not cartoon villainy. Big players hedge, producers hedge, consumers hedge, banks intermediate, funds chase, market makers manage books. In calm markets, this creates liquidity. In stressed markets, the same system can create air pockets because everyone's risk limits tighten at once. Spreads widen, not because someone flipped an evil switch, but because liquidity is a balance sheet decision. And when balance sheets get cautious, price has to move further to find a willing counterparty. That can look like suppression on the way down and panic, or on the way up. Same mechanism, different direction. And that's not the part that matters. The part that matters is how you track it without getting lost in ideology. So here's the clean tracking method I promised, the one metric combo that ends most arguments. Don't track just spot. Track premium to spot in the retail world and track the curve signal in the futures world together. Premium to spot tells you whether the retail pipeline is stressed. The curve tells you whether urgency exists in the wholesale paper settlement layer. When both are elevated, premiums wide and front end tight, the market is telling you scarcity at the margin is real right now. When spot is rising but premiums are calming and the curve is relaxing, the market is telling you the squeeze heat might be cooling even if the trend remains bullish. And if spot drops but premium stays stubborn and the curve stays tight, that can be a warning that the physical layer didn't T actually fix, meaning the drop may be more about leverage flushing than supply becoming abundant. Because if this one level breaks, the math changes and the narrative crowd will be late again. Now, what should you watch specifically over the next week or two? Watch whether dealers keep widening premiums or whether they start competing again. Watch whether in stock returns broadly or remains patchy. Watch whether buyback quotes get more confident or more defensive. Watch whether the market keeps respecting the low to mid-90s zone as a demand area or whether it starts slicing through it like it isn't there. Watch the behavior around the $100 area. Does it reject and fade with heavy selling, or does it pause and then push through with less drama? Watch the speed of the moves. A market that's tightening often shows sharp upside bursts and sloppy downside flushes. A market that's exhausting often shows choppy upside and heavy downside follow-through. And that's where the real pressure starts, because speed is information. Now the risk reminder, loud and clear. Price can whip around violently even if the thesis is correct. You can have the right macro, the right structure, the right supply argument, and still get a drawdown that tests your resolve. That is not the market proving you wrong. That is the market stress testing positioning. If you can't survive the stress test, you don't get to see the payoff. So build your plan around survivability, not around dopamine. That means respecting the two scenario lens we laid out. If we get the controlled pullback and retest, you want to see stabilization in the physical symptoms and a retest that holds key shelves. If we get the continuation squeeze, you want to avoid chasing the most emotional candle and instead focus on process. Where does it consolidate? How does it behave on dips? Does the physical layer stay stressed? Does the curve stay urgent? In both scenarios, the goal is the same. Don't let volatility turn you into a forced participant. And here's the subtle part. The market will try to lure you into binary thinking. Either it's a squeeze and it goes straight up, or it's over and it crashes. Reality is messier. You can have a structural bull market that still does vicious pullbacks. You can have a squeeze that still pauses. You can have a market that looks over and then rips again because the underlying tightness wasn't promo-houred resolved. That's why your job is to keep watching the stack, not the storyline. Premium behavior, curve behavior, deliverable availability signals, institutional flow tone, price behavior at key zones. That's your dashboard. Now, if you're still here, you're my kind of investor, the kind who doesn't outsource their brain to a headline. So here's the quiet CTA, no begging just identity. If you want to be part of a corner of the market that watches mechanics instead of narratives, stick around for these updates and share this with the one friend who keeps pretending silver is just a shiny rock. Because what's happening right now is not about shininess. It's about liquidity. It's about urgency. It's about the difference between a quote on a screen and a product in your hand. And the next detail is what flips the whole setup. In a market like this, the winners aren't the loudest. They're the most prepared. So, to wrap it tight, silver turning illiquid at dealers is a symptom of strain, not a slogan. The hidden detail is deliverable versus non-deliverable supply, the optionality that makes headline inventory misleading. The why now is the calendar meeting, thin liquidity meeting positioning, right when the market is already jumpy. The mechanism that can accelerate this is reflexive buying, short covering, and especially options hedging that forces buying into strength. The proof stack shows up across layers: violent price action, widening premiums and availability issues, deliverable supply focus, curve urgency, and institutional absorption. The risk is that volatility will try to weaponize your emotions. The shield is process and scenario thinking. And the roadmap is simple. Watch behavior around the psychological 100 zone in the active demand shelves in the low to mid 90s and around 90. Watch premiums and the curve together, and watch what changes first. Because that will tell you whether this move is cooling, coiling, or escalating.